Hi, I'm John Mousseau. I'm the CEO of Cumberland Advisors and direct the bond area. And I'm with my good friend Dave Berson, who is the chief economist of Nationwide Insurance. And we're up at Camp Kotok in Grand Lake Stream, Maine, enjoying a weekend of fishing, Fed watching, forecasting, etc. And what I wanted to ask Dave about today was, why do you think that at least the Fed has consistently undermeasured inflation, or rather overmeasured inflation, and that inflation has consistently been lower than they wanted it to be?
You know, it's not just the Fed, John. And Jay Powell said a couple of weeks ago when he was testifying before Congress, the thing that they most don't understand is why inflation hasn't moved up by more. The models suggest, as tight as the economy is, 10th year of economic expansion, unemployment below 4%, inflation should be higher. It's not. Is it a problem with the measurement? You know, on the wage side, where wages are up but not decisively, we and other financial firms find it increasingly difficult to hire knowledge workers, data scientists, people like that, people with very special backgrounds to do analysis. They don't exist, and if they do exist, and of course they do exist, everybody wants to hire them.
Right.
And so wages are going up there very rapidly. Why does it show up in the wage data? I don't know.
We found the same thing, and it's really only been in the last year that you say it's very hard to find a person with skill sets of X, Y, and Z that you would like to hire. In fact, some great anecdotal evidence was right up here in Grand Lake Stream, Maine, which is in a fairly challenged economic area. And yesterday I saw for the first time in 10 years signs saying, "We're hiring." You know, so you think about it, it's a slow process to get there to where actually enough participation starts to produce, you know, rising wage growth.
You know, it's been the slowest economic expansion in U.S. history, but it's the second longest,
right.
And next July, it'll be the longest ever. And I'm absolutely convinced we will be the longest ever. And so what we've made up for in strength, we've had in length.
Right.
And length brings the unemployment rate down, and I think there are labor shortages in many sectors, in many parts of the country, and it may just be that you need to get to a certain level, somewhere under 4%, to really see wages and prices take off. And we may well see that.
Yeah, and I think maybe it takes a little more, believe it or not, hikes in short-term interest rates, which produces a greater velocity of money among certainly banks and stuff. And as actually the Fed has actually raised rates, inflation, while it's not high, has gotten off the doormat that it was on.
It has, and you know, one of the things that affects long-term rates is expectation of short rates.
Right.
If the market becomes convinced the Fed is going to raise short-term rates,
right,
that will push long rates
up. Push rates up, right. That's good. Well, thank you, Dave. Appreciate it.
John, good to see you.
Okay.